Good morning, everybody. This is Jeff Scott. Happy New Year. I hope you had a healthy, safe, and happy New Year's and New Year's Eve. It is January 3rd, 2016, and this is my weekly report as well as somewhat of a past year review. I title it, "It May Be a New Year, but Old Concerns," and the ... persist, and I think hold some clouds over the market over the next couple of weeks. But now for the story. Disclaimer, this is for education purposes only. I'm a doctor, not a broker. I am independent. Every tool that I use, I paid for. No one pays me to say good things or bad things about them. And trading involves risk, and you alone are solely responsible for any investment decisions that you make. The most important thing that you can do to win at this is to get educated. You don't play football without spring training. You don't swing a bat or a golf club without practice. And you start with education, and then you put a lot of hard work in, and the same is with investing. These are two different areas that I concentrate on, and I've sort of narrowed my focus for my approach and my continuing education. To the left is the world of canceling. O'Neill's book, brought to the modern era by Morales and Katcher, shorting by Morales and Katcher, maybe apropos this year. Ian Woodward, Ron Brown, two great guys that have really taken some of O'Neill's stuff, improved upon it, and worked with George Roberts of HGSI software to create a software tool that automates it. So I like to think that I started with canceling and then expanded it with the work of John Person. John's been trading for 30 years. He's an author, well-respected teacher, lecturer. He's also a trader. And he's got some great tools that haven't changed for decades that I use for screening and also for managing my trades. Highly recommend his two books. Here's John at one of his live seminars. And then I take these two worlds and I add Van Tharp's position size and money management. And then down here in the lower corner is my friendly Canadian George Lee, just a great trader. He's really been, similar to me. He's taken a lot of things that he's learned from others and put it together in his own way of trading, and puts on a number of live events that I highly recommend as well. Now, I have a lot of different tools on my computer, and I usually remember to double-click my desktop to make it go away so we don't spend time worrying about them. I use TradeStation and Thinkorswim every day. Genesis is always in the background as it's my favorite thing to look at futures in the market. Unfortunately, as you get older, you get up at night sometimes to visit the little porcelain receptacle, and on the way I usually take a look at my Genesis and see what the futures are doing. From an analysis perspective, I use HGSI as my major tool, EdgeRater, to supplement that. I'm a big fan of seasonality. I'll let the seasonality companies fight their own wars, but I will say that Best Choice was recently sold, not to me, and is hopefully going to be have the interface modernized. It's always been a great tool, and I think I have all three: Magenta, Seasonality Trader, and Best Choice. As I said, I'll let them fight their own war. And then I'm a friend. I use a number of different websites as listed here. So this is what it looked like, not Friday, but Thursday. Since the market didn't trade on Friday, it looked that way on Friday as well. It was a bad day. If you look to see what's green, I see some gold and silver. I see some natural gas and some bonds. I see some energy, including the beat up E&Ps, as well as some of the oil services, some of the oil production companies here, the bigger guys. The bigger guys are up here. That's about it. Again, I mentioned gold miners, but you look through, even utilities got slammed. There was no prejudice in the sell-off on Friday. Everybody got taken to the cleaners except for some of the energy plays, which have been pretty beaten up. Financials, all losers, regional banks, insurers, broker-dealers, so on and so forth. When I look at daily charts and just E-minis, NASDAQ, and YMs on the top, then TFs, which is Russell futures, the VIX, and the dollar. What I see is topping. I see, failure to get back to prior tops here across the board. Failure at a confluence of major moving averages across the board, the Russell being the weakest. These little yellow arrows that you'll see on the 4 major futures show that they're in daily sell signals. The VIX, there's a daily buy signal in there. It's hard to see. VIX looks like it's on top of some of these moving averages and heading up, which can never be good for the market. And the dollar also on top of the moving averages. If I look at a weekly, I know this is hard to see. I'm doing this more for descriptive. We'll get closer looking as we go. The same thing. Is this a rolling over topping pattern? We've been saying this for months. We've been waiting for the breakdown. We've had some nice shots across the bow, like the famous August 24th, but it remains to be seen if this is or when this will be a major breakdown. Now, I look for clues and other things. This is a TNX-X on Warden, the CBOE 10-year Treasury Yield Index, and it's really going sideways, sort of forming kind of a wedge here. Not that I think a wedge means anything in interest rates. And this was an old line of support that I'd written before, and we're below support, meandering sideways. I think that higher rates would be a vote that the economy was improving. Higher rates as depicted here. I guess if Janet does a lot of rate increases, that might also be supportive of the idea, but it's probably likely to hurt the economy. If I look at the 50-day moving average of the, if I look at the AD line, you can see the weekly AD line failed at the yellow, which is the 50, and the white continues to break down. If I look, and you can see how closely correlated, frankly, the S&P 500 in yellow and the AD line in white have been the whole way up, and you could see the AD line is broken down. On the daily, you could see how there has been now sort of a divergence between the AD dropping and the price holding to some extent. My guess is that the AD is going to pull the price down, but we'll see. Participation on the daily, the number of stocks, these are weekly, trading above the 200-day moving average has come down a lot over the last couple of weeks. I guess this is a daily chart, and you could see it's now broken above or below its trend line here that had been sitting here for a while. That just shows me weakening broad-based of the market. In fact, the number of stocks dropped above their 40-day SMA have fallen. Now, there's a lot of ways of reading this. We're sitting about at my arrowhead here. I know it's hard to see. When we get down to these levels, you expect the market to bounce. We could have a couple more days before we get to that range. Now, the canaries in the coal mine are something that, as you can see here, are some major stocks that we watch. And you can see over the last year, they've been up 35% and really flat over the last week or so, up 11% the last 3 months. I use these as sort of as a barometer of the market. Now, they've so outperformed the rest of the market in 2015 that perhaps they're a barometer of themselves and not of the market itself. But I look at this, and we talked about it last week, that we've been sitting on this 50-day moving average. Whether this is a great place for it to blast off and make new highs, or is the party almost over? I'm bothered. It broke through and closed below the 50-day moving average. Now, what's interesting, I don't know how this it came out okay. These are the FANG stocks. We got Google up 44% of the year, going sideways, pull back a little bit Thursday and Friday, but well above its 50. We've got Facebook up 34% on the year, it looks like. Sitting just like the chart was for the Canaries themselves, with Google sitting right on the 50, Facebook right on the 50 and looking like it's broken below it. I've got Amazon looks a lot like Google, well above the 50, but pulled back some on Thursday and Friday. And then I've got what's been a big mover this year, Netflix, looking a lot like Facebook, knifing through its 50. So we have some clear elements of weakness in FANG, and I think FANG has been about the only thing that's been propping this market up. So if FANG rolls over, I think this will pull the indices down with perhaps some of the more broad market indicators of a weak market. I follow a lot of different things. One of the things I follow is Lowry. They've shown over the years that when the selling index in red, selling pressure is above the buying pressure, that foretells bad things for the market. I have my daughter's boyfriend works for them, and I've been asking them every time the market rallies, we're not seeing that selling pressure drop below the buying pressure. And I think they've been struggling with that. But I think maybe they shouldn't be struggling with it. They should be applauding themselves as they've maintained a longer-term bearish stance because of that inversion of the pressures here, and that may be accurate and may be indicative of what we're feeling in the market on a day-to-day basis. So the thoughts: low volume holiday week. So clearly, the market is under pressure, but perhaps with volume coming back in this week, maybe that will change. Again, laggards led a weak end of the year. Santa. Well, I thought the Santa rally is from the day after Christmas to the day before New Year's Eve. If that's the case, we didn't get a rally. Perhaps Santa came early because we did have somewhat of a rally the prior week. When I look at charts, and I looked at 500 or 600 charts yesterday, what's working? I tell you, not much. Some of the beaten up energy plays, especially the MLPs, some of the drillers, refiners, oil tankers, several of these with big dividends, and some of the media and broadcasters. And then what happens in the next week? Will people be selling their winners from 2016, 2015 so they can avoid paying taxes until 2017 and use that money to buy other things? Perhaps to make up for some of their tax bill from last year. Maybe it's to make up for some of their losses. But will there be selling of winners in the beginning of this year, which could further damage FANG? Longer term, is this still 2011, which took another several months for the market to recover? Are we in a topping period? I think we remain there. Then we have the issue of sort of a divergent world where the U.S. is tightening and probably leading from an economic perspective, but not, I don't think, robustly. And while the rest of the world seems to be easing. Maintain risk management, and historically presidential years are not the best year of the market cycle. Speaking of cycles, markets are cyclical. I think we remain up at a truncated sort of an oscillation here, kind of like a sine wave. And I'm looking for that suggestion to me that we're done falling and ready to move up. I just didn't feel it when I was looking at the market this week. It still kind of feels like we're over here where the market continues to feel rolling over. Now, the problem is for the last year, and this is what you get in a choppy market, the minute you think it's rolling over, it gets another leg up and another leg up. One of the times, maybe it's this time, maybe it's not, we're not going to get that leg up. Therefore, I am in raised cash, taking smaller positions, and I've even sold some premium and taken some less bullish, aggressive approaches to my longs. This is a big news week. It might be come back from the holidays, but we do have some employment and payroll numbers for Friday, first Friday of the month, or the first non-holiday Friday. We got some other fun things, energy. We've got some credit numbers, mortgage indicators, auto sales. So there's a lot of market moving types of information. There are more earnings than what's listed on the right. Those are some of the larger ones. And since I didn't recognize any of them except for DSKY, because it's one of those Chinese stocks that had a nice move when their CEO said they were going to take it private and relist it on the Chinese, the Shanghai exchange. Other than that, I don't recognize those. Not a week for big stocks. I think Qihu might have earnings this week as well. today's agenda, the usual. You've had my introductory comments. We'll do a market review, which will include some of my year-end analysis, top-down approach. Frankly, I'm not going to find a lot of stocks for you to buy today, which maybe that's a bullish sign from a paradoxical perspective. Do a little bit bottoms up, and then chart of the week. So the chart of the week is something I started doing to be more practical than just looking at spreadsheets. And it's trying to identify a pick that I'm interested in buying. I apply why I buy it. I show you what I'm going to buy it at, what I'm going to sell it at from a stop and from a target. And then if the trade executes, then I actually take the trade in my own portfolio so no one can say that I'm putting you at risk and not taking the risk myself. But this is not about stock tips. This is about me showing you how I think, how I manage my trade, and it's not to be taken as a recommendation, but more as an educational tool. Last week I picked CXRX, which is Concordia Healthcare. I picked it for a number of reasons. It looked to me, after being beaten up, it was starting to base. It had a couple of kahunas come in. The relative strength broke out above the S&P 500, had a nice move the prior Friday, come out of a mobile breakout on a squeeze and all clean green above. And this is, to me, kind of like blue sky opportunity where there's not a lot of overhead resistance, no moving averages to get through. And I've had some big winners come from here. My recommendation was if the market was strong or stable. I gave you some buy points. Said I'd buy about 450 shares for every $2,000 of risk I'm willing to take. So what happened was the white line is the buy mark. You can see that on Monday, remember it was only 4 days last week, we actually took out my buy signal but had kind of a shooting star, and the stock remained flat the rest of the week. I think I'm down about 30 cents a share on my position, considering that the market was down quite a bit more percentage-wise, or was down for the week. I won't say quite a bit more. I would say that was a neutral trade. I'm still in it, but my stops are, as I mentioned, are relatively tight, and you can see the red line down here. We'll come back to this. So I've done a lot of analysis in HGSI and EdgeRater, so what I'm going to do now is just go through some of the highlights of my results that I've stuck in a spreadsheet. So let me make this a little smaller. So the first thing is, if one was new to me and new to our trading philosophy, one could legitimately ask, what's this crap about EPS, relative strength rank, and what does it matter? So this is sort of my analysis to show you from a big picture that even though it wasn't a great year in the market, some of the philosophies that I follow actually mattered. So I took data from January 1st, 2015. So I'm not taking today's data and showing you what was working on, if you had bought what was working on December 31st of 2015, on January 1st you would have made money. Well, of course, that's what was working the end of the year. I'm taking what the fundamentals showed me on the first day of the year. So the first thing is ERG, which is a combination of EPS rank 0 to 99, relative strength rank 0 to 99, and group rank 0 to 99. I like to believe that ERG helps me understand the more ERG, the better the market moves. So let's see, there's something I can, hold on one second. So one of my philosophies of trading that I learned from Ian Woodward is that as ERG goes up, okay, the gain goes up. So what do we find here? There's the ERG axis. Here's the percent gain axis. And what we found is that if you take away the tails, and I take away the tails because the number of stocks here get less than a couple, and I just look at the main body, that clearly as ERG went up, your return went up. So ERG is associated with a higher return. On the left, I took every stock in the market, and on the right, I filtered for $2 and 150,000. The patterns are the same. You will notice that the percentage of gains were very teeny-weeny, both gains and losses. This is the true essence of a flat-looking market. How about the roll? Whoops. I don't know what I just did. Let's see what happens when that stops. Of EPS rank. Okay. As you could see that as EPS rank went higher from left to right, the loss became less and less, which meant that you had higher returns at higher EPS ranks. If you look at relative strength, you had higher returns as relative strength increased. Now, group rank is less meaningful over a long period of time because one expects there to be fairly substantial group rotation. So I don't look and expect to see that those stocks in the highest groups necessarily outperformed because I'm looking at the groups on January 1st of 2015. Not much to say about this one. Now, what about accumulation distribution? This was a challenging year, but you could see that the A and B stocks from January 1st actually had less losses, or said a more optimistic way, actually outperformed the market over the course of the year. The boxes didn't work. There's kind of a smushing here. And even box 7, which is my favorite box, which seems like it most underperformed, was only down 0.2%. Now, when I look at the filtered by $2 and 150,000 shares, all these parameters seem to hold up. So what I don't like is the small gains or losses that we saw. But if I look at just relatively, ERG mattered in 2015. EPS rank and relative strength rank really mattered. And I think that, personally, I think that the most impressive input on my portfolio is relative strength. Now, you might ask then, how does 2015 compare with 2014 and 2013? So I've looked at it. So for 2014, I used data from January 1st, 2014, and 2013, I used data from January 1st, 2013, from the fundamental perspective. Now, 2014 was a crazy year. It was a crazy year because this was a year when we thought we saw a lot of junk off the bottom, a lot of dividend payers. And it's hard for me to say that there's any relationship between ERG and return. Certainly, there's no relationship between, well, maybe relative strength, but hard to really make as much of a case. The boxes are all over the place, and actually the groups that did best in 2014 were letter D, or groups that were distributing the prior January 1st. Now again, this was not the norm. And we spent a lot of time wondering, was the game over? Does high growth not matter anymore? Does relative strength and EPS rank not matter? Although I don't like the performance overall, I do love the fact that EPS and relative strength do appear to matter. And if I go back to 2013, now this looks flat, but again, we're throwing out the head and the tails. So you went from a 30% return in the lowest ERG stocks to a 55% in the high ERG. So 2013 should have been a great year for you. It certainly was for me. And again, although you always get some low EPS and low relative strength rank stocks actually doing well, when you really look at the pattern, though, there's no question that EPS rank, relative strength rank, and ERG mattered. And in a normal year, A and B stocks had the best performance, as did box 7s. So 2015, I look back and say, not a great year from an overall market performance. Certainly there were areas of leadership like FANG, but it actually behaved as we've seen in the past. In 2014 really was an aberration, because if I went back to a 12, 11, 10, and even 9, I saw similar patterns to 2013. If I look at last week, I got only a few groups that were black. The vast majority of my performers were red. These are different groups that I follow. Now the S&P was down 0.6. Anything that I was holding going into the week was down about the same. HGS 100 a little bit better. The IBD 50 was a little bit worse. My buy list is usually kind of aggressive, and it was down here, down 1.16. I only buy things when they work. I put together an aggressive list, so usually it outperforms to the upside or downside. Doesn't perform like the S&P. It's just a shopping list. Interestingly, the GIF All-Stars, which are some of the best performing stocks from the week before, actually was about the same as my buy list. So not a great week for the market, and growth kind of performing the same as the S&P. From a seasonality perspective, there are some things that work over the next 30 days. I've ranked these here by number of up years. Over here to the right, probably more important, I've looked at those stocks with at least 8 up, no more than 3 down over the next 4 weeks. And some of the standouts, Paraxel up 18 out of 20 years, 12%. I don't know, Ferrellgas Partners, but up 4%. Excuse me, Alkermes, a pharma company, up 17 out of 20 years, an average of 12%. Illumina up 12 out of 15 years, an average of 14%. So there are some things that are working. Netflix. Now, when I look at it, I see 10 and 0, but starting the middle of the year. If you started right now, up 10 out of 13 years, an average of 20% return. And then you have the things that are not working. This is analysis in EdgeRater. If I was showing you Seasonality Trader, for example, I might open up the calendar function and say, here's January, and I might set my minimum of 10 years. I want at least 90%, and I want a 10% win, or else I don't really care looking at it. And this will populate a calendar that would be things that meet my criteria. So I might say, I'm just thinking about things that, this looks interesting, LNG. So LNG doesn't look that interesting. The numbers, okay, starting January 11th, I'm going to go ahead and skip this chart. Although the numbers look good, I think there's an error in the calculation. 404% doesn't make sense. But I will show you what I am looking for. I'm looking for things like Netflix, which, let me pop up again. Hopefully I don't have an issue. I have to go reboot the program. I think I may. Let's see. All right, let me shut it down and restart it. But I love to scan for aberrations, and the reason why I scan for aberrations is I'm looking for an edge. I'm looking to find something where odds favor it doing what I want it to do. So 10, put this back to 90, and 10. Now let's take a look one more time at LNG and see. Yeah, okay. Don't know what was going. Not a great example because it's not been behaving. So here's LNG in a downward channel. Because it's in a downward channel, I'm probably not going to take a trade. I would like to see it in an upward channel, but look at the seasonality. The yellow represents 5 years of data, the green represents 10, and one can see we're going in a fat green area here where from January 1st to February 26th, up 9 out of 10 years, the up years averaging up 28%, the one down year down 0.9%. That's a seasonality play. I just don't like how it's behaving coming into its seasonality. If I look at Netflix, for example, Netflix, similar pattern on, I didn't just redo that, did I? Let's try this again. Okay. So Netflix also in a downwardly channel. Now Netflix, sometime around the 19th or so, the 18th of January, goes into a period where it's had 10 out of 10 positive years, the average return of 30%. So knowing that will probably affect how I trade. Now the challenge I have with both LNG, which is in a downtrend clearly, and Netflix is, where's the stock going to be on January 17th? If I knew the stock was going to be in this range, it might be okay to start buying options now because the intrinsic value hasn't gone crazy yet. On the other hand, maybe it's at 100, and maybe the return is 110. So if I buy expensive calls today, I may not make money on them. I typically wait until I get much closer to Netflix unless I have a position in place coming into there. So I'm using seasonality as part of my approach. This picture here is to show you that there's not been a Hindenburg omen going back since August. I'm looking at the category, it says no. We did see a series of them back in June 25th, June 10th, and June 11th. If you think about it now, that's kind of when the market peaked. We don't usually see big corrections without a Hindenburg, but you got to be at near new highs typically for you to start seeing that. For those that have no idea what I'm talking about, I have two different ways of calculating the Hindenburg. It seems in the older days versus current, there's been changes in the makeup of some of the indexes, so I include the old and the new. But if I go back to 2008, 2007, maybe not because I didn't give it enough time here. Let's see what I need to do. I need to go in here. Oh, it's Tesla. That's why. Never mind. Look at the S&P 500 and let's try and go back to 2007. We're in a big market run up here. A single Hindenburg we don't spend much time with. Looks like you had a big move down here in February of 2007. Market recovered, went on to new highs. Now, pull back to the 50, failed new high here, pull back to the 50. We now had 3 Hindenburgs. That may have been evidence right there to start getting out of the market. Another new high. You notice the march of Hindenburgs as we get up towards the ultimate high and no Hindenburgs on the run up. At some point, whether it's when the weekly bongo went red again, whether it's breaking through the 200-day moving average, probably not just touching the 50, you probably want to get out of that market. Now, sort of a fake because you could have gotten out of the market. Then the market had a big bottom here. So if you'd gotten out after the series of Hindenburgs, you have to pick what would have gotten you out. The market had a pretty deep sell-off, but then it recovered. So you know what? I could have just pinched my nose, stayed in the market, didn't look at my balance every day. I would have been fine. So now we're in 2007, and now November of 07. If you knew what the Hindenburg was, do you think that this series of signals topping candle, failure to break back above the 50, might this have gotten you out of the market? Would have been a nice time to get out, wouldn't it? Notice you don't see another Hindi. Failure at the 200. And ultimately going down to the lows. So what's the message here? The message is we've got some pretty good signals. And if I combine the Hindenburg with the weekly bongo and look at the relationship to the major moving averages, I might get myself a early warning signal of the market rolling over. I don't have one right now. That was the point. Buckets, 2/3 of the stocks are below the average, the midline of in the S&P 1500, the midline of the Bollinger Bands. That is bearish. When I look at the distribution of stocks, we're certainly not oversold. We can get worse. If I look at the markets, this is the Woody indicator, and what we're looking for is the color of these bars. Yellow is chop. I look for periods to make money either long or short. But when I see periods that are back and forth, chop, 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 it's hard to make money being long or short. We've been living in chalk. And then I'm not going to go through them, but I have a number of setups that I find using EdgeRater. For example, code blue would be some bullish looking charts that come out of Morales and Catcher signals within EdgeRater. Notice that MEG, Liberty A, Liberty H, LVNTA, these are all media stocks, media and broadcasting stocks. UUP is the dollar is a position as well. Enough of that. Let's go take a look at TradeStation, see what market signals we're seeing. We go into the NASDAQ. I'm going to go quickly because it's a broken record. Remember, the arrows are person buy and sell signals. This is daily, weekly, and monthly. The bar color is an elder buy-sell signal. He can be buying when it's green or blue. He can't be shorting. He can be shorting when it's red or blue. He can't be going long. Blue is sort of the indeterminate. What do I see here? I look for, dots, which would be evidence of a potential MACD divergence. I'll show you them if we see them. I'm in a new daily sell on the NASDAQ. I'm in a weekly sell, still in a monthly long. So long-term uptrend, still short-term weakness. Need to be careful in the NASDAQ. I look at the Dow Industrials. Sell, sell, monthly buy. Same picture, weakness in the short intermediate terms. I look at the S&P 500, broken record, except it's in a sell long term as well. And I look at the Russell 2000, which has been the weakest. Daily sell, weekly sell, monthly sell. Lots of sell signals on the market. Not a time to be taking a lot of risk, big positions, lots of margin. I look at some of the industries, materials, sell signals on the daily and weekly. Energy, interestingly, despite it being the weak sister in some ways, had some MACD divergence or convergence with these green dots. Here's divergence with the red dots. And you can see it's actually got a daily buy, although weekly and monthly sells. Been in a robust downtrend, as you could see on the monthly chart. Utilities, you would think they'd be strong with the market in turmoil. They actually had a sell signal come in on Friday, still in a weekly buy signal. One of my favorite places, healthcare, now into a daily sell, weekly buy, monthly sell. And then I think Staples was probably the strongest. Was it not Staples? XLP? Well, nothing's really strong, but XLP still in a weekly and a monthly buy signal. Went to a daily buy on Friday. And notice the concerns about MACD divergence with those red dots. Again, not a real bullish time in the market. Take a look at HGSI. Let's go back to the idea of looking at the market in review. So I've added a column here, changed from the beginning of the year, looking back to January of 15 rather. And one can see that the leadership of the market has been the IBB up 11%. Good for me and good for many of you that like biotech, but let's not get that excited because let's bunch this up a little bit. Is that what I want to show you? Yeah. Here's January last year. So let's just do this. So this was the best of the market. We'll make January, the start of January on that little doji bar. that's where we started. That was the high. This must be the August 24th low. Here's the low. So the good news is you made money almost whenever you got into biotech this year. Let me fix that line. So if you bought in January and you held until year's end, you made money. That's the good news. The bad news is if you bought on January 1st, sold at the top, you would have been up 30%. If you bought on January 1st, we'll see how close we come to this, and you sold it on the end of the year, you'd be up 11.6, 11.4%. So the market ran up 30%, and then it ran down. And this is the bad news of biotech. It dropped 29% in 25 trading days. So if you're a biotech investor, you had a good year, you made money. The bad news is, boy, I hope you had an iron stomach because there was a lot of tough times in biotech. So biotech looks like the big winner, the NASDAQ 100. Now, what would be leading the NASDAQ 100? I have to go back up here. There were a couple of errors in the database, so ignore some that look silly. Some of the IPOs got treated bad by the database. That has to be fixed by George. Let's look at the NASDAQ 100. So, I guess in this view, they look better. All right, so the NASDAQ 100, the leader of the year was Netflix, up 134%, followed by Amazon, 117%. You look at the rest of FANG, Google was up 46%. Facebook was up 34%. Clearly, there's some big stocks here that led the market higher. How many of these do you own? Now, if you go through and look at these stocks, many of these stocks are the same stocks we talk about every week in the market. Let's look the other way. Who lost? 60% down on Micron, Wynn, Staples, Viacom, Seagate, Bed Bath & Beyond. Some of these are great companies. They just were bad years for their stocks. If we look at the S&P 500 really quickly, all right, so I would, up until Netflix, I'd ignore all those because those are all new stocks and there's something weird with their calculation. Cuervo is not a new company, it's a new stock. There was a merger. I can assure you Cuervo was not up 1,200%. Netflix, as you could see, again, leading the S&P 500. If you look at it, it's really the same stocks. So this was really a NASDAQ 100 or a very narrow group of stocks that led the market this year. Let's take a look at where we are right now. And you could see that for the last week, gas, commodities, volatility, the dollar. Gee, what do these have to do with my stocks? Nothing. Partly why refiners were up, I think, was the volatility, the gasoline. The major indexes down here, small caps, laggards for the week. Let's just take a look at a couple. So back here, which is probably 2 weeks ago, or is that a week ago, I talked about how we were sitting on a confluence of major moving averages and that we were likely to break up or break down, but we were squeezing, and what we can see here is we seem to have broken down. Now let me just go back here. All right, we're not currently squeezing. The squeeze came out about a little while ago. Okay. And there was no kahunas the last couple of days. Go back to this view. Let's kill all my notations. So what do I see? We've now got a daily and weekly bongo where, yes, we failed at the 200-day moving average. Wow. We do have some trend line support here, so that could be a natural place to bounce. I mean, it could even maybe come back here and say I got trend line support all the way back here. It'll be interesting to see what happens this week. I think the market, my sense is that the market has got some more to drop. It'd be nice to see a big bounce and a rally for the new year and get back above the 200. Maybe there's no major terrorist attacks, at least none yet. Jews don't usually knock on wood because I think it's knocking on the cross. But on this note, I'll knock on wood. Thank God there wasn't a major terrorist event in this country with Times Square and all the big targets. But clearly, breaking down from a confluence of moving averages in a new bongo can't be a good thing on the S&P 500. I look at the Dow Jones Industrial Average. The story is the same. Bongos. And I'm just curious if I draw a trend line here, where does this take me? Interesting, right to where we are right now. So I'll bring it out here. So again, looking at that trend line, maybe we have a little further to go before we get to a position of bouncing. This is the Dow Jones. If I look at the NASDAQ composite, looks a little bit stronger, but it does have the bongos in place, pulling back towards that 200. And if I look at the Russell 2000, which has been the weak sister, has failed here at the 50. I hate to say it, but darn it. One of these days I'm going to figure out how to use these tools. Touch it. Shift. All right. Is that my target? Well, that's probably where my risk is. That's getting, be a pretty significant, another 60, 70 points down here on the Russell. Russell's weak. I can't say anything positive about the Russell. You know, maybe there's some support coming in down here. I look at the bongos. I look at the overall large market selling off. The Russell looks the weakest and is very worrisome. If I look at the dollar, you know, dollar is a position. Maybe this is the place we ought to have our money because the dollar, unlike the others, is in a nice uptrend. Has it bottomed and turned up? I don't know. But the dollar was up, let's see, go back here, was up 0.5% on Friday. Now the weekly bongo is still red, which is worrisome. It has pulled back from its peak. But if there is strength in the U.S., if there is further tightening, then one would expect the U.S. dollar to rise. The VIX. Last week, I think I pointed on the fact that, you know, we're down, we're low. We had sort of a hammerish looking stick there, but we're not very low compared to where we've been over the past year. In fact, somewhere in here has been where we bottomed, and we're nowhere close to that amount. So our higher bottoms, a sense that the VIX might be trending up, I don't know. It had a shooting star on Friday, which would be good for if you're bullish in stocks. It's hard to know what to do with, Thursday, with the low volume volatility day that we saw in the markets. But I'm going to be watching the VIX closely, knowing that in times of a sharp rise, it's not a time to be long the market. And then gold and silver. Not much happening here with gold overall last week. And if I look at silver, you know, relative strength-wise, these are probably holding up well compared to the rest of the market because the S&P is sold off. But you know, these are just in a horrible bear market. If I just go to a weekly chart on silver, hard to know where you're going to make money going long silver until there's a big change here. All right, so I think I've made everybody depressed looking at the market, certainly depressed me. Let's take a look at some industry groups, see if we can find any strength there. Two-day force, I've only got 10 positive groups. 2 days down, I've only got 10 down groups. But if you look at the down groups, utilities, pharma, banks, large pharma, specialty pharma, tobacco, entertainment content, steel. Boy, those are wide range in some very big, important parts of our economy. And you compare that with the, let's see, 2 day up. I've got exploration, midstream, marine shipping, and refining, and oil and gas services. I got 1, 2, 3, 5 of the groups are in the energy 6 coal operations. That's really been a great place to be. So we got 6 things here that are energy. I got power generation, cement, cable and satellite. Boy, not the stuff that America's made upon, with no disrespect to those of you in the energy business. Not my typical group of winners. 5-day up at healthcare supply chain, but really not much different. And if I look at 5-day down, that tells me that the force index over the past 5 days, price and volume, momentum, for the majority of the stocks has been heading down, which again is consistent with a market that's under pressure. Being the perma bull, let's see if we can find anything to buy. Midstream oil and gas. There are some here that I liked, and I liked them probably not because of the chart as much as I like their dividends. Let's go into, this is Williams Company. Notice I put this box here. Thanks to Ron for pointing us out on his webinars. Highly recommend his webinars. And George for including this, but the ability to take anything that's in a warehouse view and have it put on the chart automatically. Let me just say a word about Ron Brown. Ron really is Ian's sidekick. He's really taken on a yeoman's job in being the troubadour for HGSI, for teaching us. Ron and I have divergent methodology. I think we both do a lot of similar things from a money management perspective, how we use the tools in HGSI. Ron has gone with the volume price analysis world, VPA, VSA, doing a lot of work with Anna Cooling. I've gone with the person world. The funny thing is, we get there differently. We find the same stocks. I can't tell you how many times I get an email from somebody saying, oh, Ron was talking about that stock too. I think the bottom line is there's lots of different ways to skin a cat. No disrespect to cats intended by that comment. And that find what works for you and use it to make money, and don't worry what somebody else is doing. If it works for you, it works. And I think there are multiple different ways, highways, to get to the same destination. This is really similar to a lot of the product companies in the midstream space. One, it pays a big dividend, 10%. Part of it is because the stock's in half. Used to pay a 5% dividend. There's been a couple of companies came out and said their dividends are intact despite the reduced stock price. So that's a really nice thing. You look at this company, its dividend per year is going to be $2.50. I get nervous. I see 39.60. I only see about 75 cents of earnings. So how do you get there? Are there other earnings that we're not picking up? Are these earnings after dividend distribution? Are they going to have to sell stock to pay dividends, which is bad? Take debt to pay dividends, that's bad. So I have to understand where the dividend money is going to come through. So if I was buying any of these, I can assure you I would be spending a lot of time understanding where the dividend money is going to be. So, but typical sideways, as many dividend players do for a long period of time, and then a rollover with the energy complex. Now, bottomed out here a couple of weeks ago, broke above the 17, had a PSAI reversal, had a mobile breakout, still in a daily bongo, a weekly bongo's red. The weekly bongo's on top in this view. 10% dividend. That's Williams Company. ETP, Energy Transfer, same start pattern, down 50%, pays a 12.5% dividend. So 12.5, so they got to pay about $3.60. I see $1.80. So I don't understand where that money is going to come from. I'm sure there are other sources of revenue to pay a distribution. ETE, similar pattern, 8.3%. EPD, 6%. So here's one that I liked, MPXLP. I like this for a couple of reasons. One, its stock price is a little bit less than 40. It pays a little bit less than 5%, so it needs $2 to pay its dividend. If I look at the next 2 quarters plus the last 2 quarters, I get about $2 in earnings. So it does look like it has earnings flow enough to pay its dividend. It broke above the 50, so I have support perhaps at the 50. Everything is here is green. It is down close to 50%, although it's up 3% in the last 3 months. We'll come back and look at MPLX later. That's one that I liked. The other one I liked was a similar pattern, not yet above the 50. Pays a 10% dividend, so it needs about $4. It only brings in a little bit over $2, so it'll be interesting to see what their story is. They're down only 30%. So are these growth stocks? Are these big winners? Are these happy days? No. They're big dividend payers that seem to have bottomed. Exploration and production. Don't know how much weight this guy gave it. This is, God bless you if you're long this stock. I don't have that many balls. 12-month return, 143% return, but the one-day return was 342. So I guess that means it's been down for the year until Friday. So why did this stock move up like that? Well, let's take a look. Let's go into FinViz. I know the answer, but I thought I'd show you how I found the answer. So you tell me. Buys up Oklahoma assets. Yeah, I agree with this. Whew. They bought for $36 million. They bought a number of wells. I guess the good word here is they're producing wells. Okay. Their value went from $2 a share to $10 a share. It's listed as a distressed energy. So I don't get it. Is your market cap worth 5 times what it was because you went and you bought something that small of an acquisition? Now its market cap is small. It's just $10 million. Maybe it's the $16 book value that gets people excited. Let's go back to FinViz and let's make sure that those are real numbers. Whoops, that's not what I want. Market cap $10.6 million. Loses $4 million of income, sales of 1.7, minimal cash per share. Earnings per share going back has not made money. I just have a hard time believing that the market cap goes up 5 times and then settles up 3.42 times based upon a small acquisition. Pump and dump. If you're in this stock, I hope you have stops. I hope you got stopped out already and you made tons of profits and you don't really care about tomorrow. But I'd be nervous holding this stock. This stock might be a big reason why this group is up here. Southwestern Energy, the other reason is natural gas seemed to go up. There's been a cold spell, I guess, being here in South Florida. We have a cold spell today. It's in the 70s. I think it's going down to 60-something tonight. The fur coats will be out. The women in Palm Beach really like the 60s. They get a chance to show off their new clothes. The weekly bongo being red, this has been a long-term sell signal, bouncing off the bottom. This is a stock that's really come down in value to the low single digits. Do you make a play here? Might be worth a long-term pickup. Southwestern Energy, buying their asset at a cheap price, but be prepared to be losing money or not making money for some time. Range Resources, same pattern, same story, loses money. Whiting Petroleum, more of the same. Do I believe that someday these things are going to go back up? Here's Devon, historically a great stock from 69 down to 32. Heck, I bet it was even a $100 stock if I go back far enough. $128 in 08. down to $32 right now. At some point, these are going to be terrific buys. I bet you if you buy most of these and you pinch your nose and don't look at them and come back in 3 years, you probably make money. But I certainly wouldn't call those growth stocks. So these are junk off the bottom. Marine shipping, a story of dividends. Beaten down stocks, Golar LNG, GLNG 11.4%. My understanding here is as long as we're producing oil in the U.S. and there's nowhere for it to go, when places like Cushing and on-land storage fill up, a lot of these tankers will just be sitting in the Gulf at $1 per barrel per month without much expense, holding the oil offshore until the price of oil goes up and the onshore supplies diminish. So perhaps these companies which are beaten down and pay huge dividends may have a little bit of a run left as long as that occurs. Golar LNG, like the dividend, don't like the chart. TK Shipping looks just like that, pays 22%. Cosmere pays 11. Tsakos Energy pays 3. So again, high growth stocks, I don't think so. Probably a special situation around dividends. And it'll be interesting to see if they're paying their earnings and their dividends, or they're paying their dividends as suggested. I'm not getting excited, folks. Cable and satellite. Bunch of Liberty assets here. These are all Liberty companies. Again, beaten up, bouncing off the bottom. This is another junk off the bottom week, perhaps. There we go, A. Now, what you can see here is can see that relative strength is picked up. You have pocket pivots and kahunas. You ran up to the 50 and failed. Starting to look some green up here. Not bullish growth stocks. But this is where the money's moving. Refiners, I like them more than I like some of the other energy plays. Not as beaten up. Here's Tesoro. Looks like it's pulled back here. Have to get above this 50-day moving average. Had a pocket pivot on Friday. How everything's red. Pays a 1.9, but look at these nice, robust earnings coming in. Okay. You look at this refiner, they pay a 2% dividend, so about $2 a share, and they're going to bring in $5 or $6. I think there's a lot more money has to be reinvested to keep everything working. Sunoco, below the 200, but clearly in an uptrend, some pocket pivots, everything is green, pays a 7.5% dividend. Suburban Propane, I don't like that as much. Allen USA, 16% dividend. Western Refining, I think they announced a deal with perhaps Northern Tier, or one of their companies with Northern Tier. Stock looks horrible, but it pays a 4.3% dividend. So are you getting the message here? You got beaten up stocks, and some of the big winners here pay some dividends. Now, you look at oil and gas services. Do you notice what is missing? Yeah, Schlumberger and Halliburton. These are some of the drillers. And some of these drillers pay some dividends. 3.9%. Beaten up, fallen angels. Neighbors, 2.8%. Helmerich and Payne, 5%. Core Laboratories, 2%. Frank's International, sideways looking chart, had a kahuna pocket pivot, mobile breakup from a squeeze. Everything is green, pays a 3.6. Below its 200-day moving average, though. So I look at these. What do I see? Beaten up stocks pay a nice dividend. Power generation. So these would be electric utilities, I guess. Beaten down stocks that pay a dividend, 4.9%. NRG, coming up against its 50. You know, having a 5% dividend is great, but if your stock drops 50% in your year, it takes you a long time to make up for the stock drop. Dynegy, down 55%, no dividend. Calpine, no dividend, down 34%. A little bit nice buying place, sitting right on the 50 with the mobile breakout. Everything is green. 11% dividend on Terraform, down 60% on the year. I wish I could get excited for you here, guys. I can't. Cement. All right. We've seen cement several times. Beaten up stock, no dividend. This is CXRX. Is it putting in a bottom with a couple of kahunas and a mobile breakout after being down 45% of the year? Maybe. A little early. How about Eagle? Same pattern. I've seen a couple of people come out and call Eagle their stock of the year for 2016. It's had its run in the past. It's put out a weekly. This was a beautiful run in 2011 to the middle of late part of 2014, but I'd like to see it resume an uptrend before I get that excited. So maybe a nice move on the week on this group, but another down group. Boy, I feel like a broken record. And these are the best of the best. Investment companies, asset managers. See if we got a pattern here. Small dividend, pull back, trying to move back up, got above the 8.17 with the pocket pivot. That's Leucadia. Fifth Street, 11% dividend. Fifth Street Finance Corporation, 11% dividend. I'd like to see it get above its 200, 11% dividend. New Mountain Finance, 10.4. Tick Capital, 19.1. Penn Park, 18. Gladstone, 11.5. Wow. Huge dividends on a beaten up stocks. I think that should be the theme of the day. Huge dividends on beaten up stocks. And then coal operations, come on. Let's see what their story is. Alliance Holdings. Huh. Imagine that. 19% dividend on a beaten up stock. And lastly, Westmoreland Coal, no dividend, but a beaten up stock. So that is your winners, folks. Yowzy. Beaten up stocks. People are bottom fishing. People are looking for exaggerated dividends. Boy. Now, I'll show you some good stuff. I'm going to review with you how I do my analysis, how I find my stocks, and then we'll close it up and say goodbye and go through the chart of the week. So I am a bit crazy. I can be more crazy on what feels like a month-long weekend with the holidays back-to-back. In my Dropbox, I put together every week something that I call transfer. And in this transfer directory, this is how I share my computers, I do a number of things. I build my lists, and from various sources, I input stocks, leading stock lists that I can find out on the web. On the end of the week, I pull in from Investors Business Daily the CanSlim, IBD 50, and then a couple others of their screens, the screens of the day right here, the Big Cap 20, and the New America, which is one of my favorite screens. From MarketSmith, I pull in everything here has an MS on it, plus the MarketSmith growth. I pick up accumulation distribution, fastest growing, top EPS, top relative strength weeks, weekly new highs. I bring these lists in because of my assumption that somebody somewhere was willing to publish a list of stocks because they believed that this list contained a number of great stocks. In HGSI, I kind of put together those lists. And every weekend, I import those lists. Now I supplement them with some of the smart groups. In HGSI, these are pre-planned lists that are done for you. Some of my favorite: squeezing PSR reversal to the upside potential, pull back to the 50 with a kahuna. Great Television is one that I liked a lot. So this is a pre-done scan. Now, it looks a little different than everything else I've showed you. It makes money, no dividend, in an uptrend, pull back to support with a mobile breakout and a kahuna. This is a buyable looking stock. Now, why did I find it? It's because this smart group finds me stocks that have pulled back to the 50 with a kahuna. So I build this super list here from smart groups, from scans that I bring in from other places, from my favorite filters and views within HGSI. These are some meta stock scans that I like, and then my TradeStation scans. I then take this and say, if these of the bullish list have the really good stocks, then why don't I combine all the stocks in the bullish list to be my universe for the week? And so what I do is I create two massive lists. One is called the consolidated buys, which is, this week was 865, met my filter, which was $2 and 150,000 shares. And a top 15, which just takes the best of the best, which was 416. Now I take that consolidated buy list and I throw it into a TradeStation symbol list called Weekly Consolidated List. And then every night I run my scans in TradeStation against that list. So here's my consolidated buy and buy one. And these were stocks that this week had a buy list, okay? And at least on Thursday had a buy. I run this every night, and I start fishing from here. And then one of my favorite signals is a weekly high closed doji, which you only get on the weekend. This is where I do a lot of my searching for stocks. So this is a way that I take all those lists and I automate a scan on a weekly basis and go from 800 stocks down to 21 on a daily basis to look at. I have a number of other scans that I do, including I do scan the entire market, and you notice that there's 20 stocks here of all stocks, and in my consolidated buys there's 21. So I must have a filter in here which actually eliminated something, or maybe it got below my price and volume. So I now have got that top 15 buy list. And what I do with that top 15 buy list is I then add to that top 15 buy list. I add the S&P 100, the NASDAQ 100, my sprinters, and several of my other favorite filters. And I get here 700 stocks. You know, I think I got the wrong filter on. Nope, I want price and volume only. There you go. I know I had closer to 800. I have 743 stocks. I then go into TradeStation in my radar screen, and I include some stocks that I'm personally interested in. And then all these, I call them tigers. And I'm able to, during the day, look at up to 1,000 stocks. So I've got in my list right now to monitor during the week, 980 stocks. And you can notice that I could be scanning them during the week, real time. I've got the 3X bears, I got the bulls, I got the various sectors, looking for my favorite signals, Bible gap ups, bongos. And then I've also got looking for new signals within John's system as well. So during the day, I'm monitoring my radar screen. At night, I'm looking at the results of my scans. And but on Sunday, the other thing that I do is I take that top 15 and I add to that top 15 the MarketSmith 250, all the weekly high close dojis and the weekly buys and the person buy one signals. And that's what I look at physically, and I looked at 491 charts. So for my weekend review, I looked at what I thought were the top 500 or so. Actually, there's still a filter on this, I think. All right. I looked at about 500 charts. I looked at those 500 charts, And these were the winners, or the ones that I was most interested in those 500 charts. So when Monday comes, these will be some of the charts that I will be closely watching to see what's happening in the market. Now, many of these we've already looked at. Now, 37 stocks is a little bit too many for me to work up and put in buy signals. I might look at my industry groups and notice that, gee, 6 of my, well, again, got to check my view here. Let me go to my, six were midstream oil and gas stocks that looked interesting to me. A couple of marine shipping stocks looked interesting to me. Some specialty pharmacy stocks looked interesting to me. So I took this 47 and I took it into TradeStation. And so let me just again review. I built this list from the best of the best. I then took 500 charts and narrowed it down to 47 stocks that interested me. This is using my traditional HGSI analysis. I took the big list, I set up scans and radar screens to monitor during the week. And then I took those 50 or so stocks, I stuck them into TradeStation here, and I looked at each of them looking at a combination of my indicators and John's indicators, and I came up with my favorite 8 stocks for this week. So let's look at these 8 stocks, and then I want to go and show you my chart of the week. Affymetrix, this is a baby Illumina. They make chips for genomic testing. Traded down, 828 was the most recent low. Now it's above $10. Why did I like Affymetrix? And to be complete, let's look at it. This is a long one today, but I got the day off. Hopefully you have the day off too. So Affymetrix on a traditional chart, coming up off the bottom, everything is green, makes some money, although not much earnings per share growth, no dividend. My concern about Affymetrix is I'm about 50 cents below the 200-day moving average. Probably don't want to be buying it until it breaks above that. A break above the 200 and a retest with this scenario up here, I'd be very interested. It's also coming out of a mobile breakout and a squeeze. In the person world, it's in a weekly and daily buy signal. It's got weekly and daily high closed dojis, which is his most important, I believe, signal. Its OBV on weekly and daily are heading up. These are some of my indicators. Just look at them on the daily. The first one is a daily bongo and a weekly bongo are both green. It's coming out of a squeeze. The PSAR is underneath, which is that green dot. It's in a weekly squeeze. So I liked Affymetrix a lot, but I held off on it because here's that 200-day moving average. I didn't want to buy it right at resistance. Cara Therapeutics. This is a biotech or specialty pharmacy stock that I know absolutely nothing about. Let's go back to my HGSI chart. And what did I see? I see a stock that actually, although it's come back a lot, it's up 69% over the past year. That's remarkable. Not a huge amount of volume, 300,000 shares. It does not make money. What I liked about it was been in a very long period of a squeeze. That's the yellow color there. Broke out on Friday, had a mobile breakout rather on Wednesday. A couple of kahunas, including one on Thursday. Everything is green here. So from a technical perspective, with my traditional HGSI indicators, it looks very strong. If I look at it with John's stuff, it had a high closed doji on Friday. On the daily, on the weekly, weekly's in a buy, daily's in a buy. OBV's heading up, coming out of a squeeze on the daily. Daily bongo's green, weekly bongo's red, which means it's been in a long-term downtrend. I look at this, I almost chose this one as my pick. I think this is a very interesting looking stock. Gray Television. I think I mentioned this one a little while ago. Gray Television. This was the pullback to the 50 with the kahuna. That gets my attention. I don't like the weekly bongo being red, but I do like the fact it's got making some money here. Trade 700,000 shares. Let's look at Gray Television. It's got a high close doji because it's an orange bar. OBV is strong. It's in a daily buy. It's in a weekly sell. So I'd rather buy it in a weekly buy, but I can take the buy after a high close doji. I like this a lot, especially since it's now breaking above that 50-day moving average. It's above the 200 down here. I think this could run up 10% pretty quickly. This is one I thought about. GGAL, I think, is a foreign bank. But this, basically, I built this list by looking at charts in HGSI, and then I picked which one to buy for the chart of the week by doing this analysis. So GGAL makes money, but not any growth on earnings, small dividend, pull back to the 50. Clearly, it's in an uptrend, made 70% this year. I got interested because of all these pocket pivots coming in and the land of green up there. When I looked at under under TradeStation with persons indicators, I see a high close doji, a weekly buy, a daily buy, strong OBV. Recently came out of a squeeze. Like this one a lot. MPLX, we looked at this before as one of the oil and gas plays. The reason why I like this one, as I told you, is because it got back above the 50, which is this white line. What do I see here? Person weekly and daily buys. Coming last week was a high close doji week on the weekly. This week a high close doji on the daily. OBV is heading up. It's still below its moving average, which bothers me some. But this one was a strong candidate for a buy if you're looking for a bounce play in a group that came to the top in HGSI that pays a dividend. Speaking of dividends, similar story here. This is NAT. This is one of the shippers. Now, not a bad looking chart. Pullback to the 50 here. Great earnings per share coming into the stock. Pays a 10% dividend. Still playing with this percent demand supply, but whenever I see anything above 1, it's interesting. This was at 2%, so there's a lot of demand for this. So this is interesting. And what do I see here? High close weekly doji, person buy, OBV heading up, coming out of a daily and a weekly squeeze. I like this one a lot. And then the two that I was most interested in, VTL I bought maybe 10 days ago. VTL is a small biotech company that got hammered, which they have a tendency of doing, and has been working its way up. What I don't like about it is it's getting close to its 200, but it's still got about $3 or 25% to get there. It does not make money. It has no revenue, so it's got to be considered a very speculative play. It only trades 442,000 shares a day. What I did like about it was high close doji on the weekly. It had a high close doji on the daily a couple weeks ago. OBV is strong on daily and weekly, coming out of a daily squeeze. Here's that 200-day moving average, maybe even 40% above, 30% above. And then lastly, wage. Now, in the HGSI chart, not a perfect chart. Stock's clearly in a downtrend. It's about to abut its 200-day moving average, but a number of pocket pivots. It's been up 5.5% the last 3 weeks. Everything is green here. Its revenue is increasing. Earnings are choppy. Let's take a look at wage. High close doji on Friday. Like that. PPS buy signal weekly and daily. Very strong on-balance volume coming out of a weekly and a daily squeeze with a number of my other signals firing. Pocket pivots, MOBO breakouts, PSAR supportive. I like this one a lot. So these were, on my entire analysis, the 7 or 8 stocks that came to the top of my list. Now let me pull up one of my other toys. So funny, the username includes your name, and they've got my name spelled wrong. Make sure we're getting data. Okay, perfect. So back to the story. So again, you've noticed how I use some of John's indicators. I don't think that there's one product that does everything. I mean, I could be pretty close with John's stuff, but I really like how HGSI does the group rotation, ranking, the charting platform, the customization of those charts that I showed you today. But it doesn't have John's stuff in it, probably never will, because he's very proprietary and he doesn't allow others to put most of his stuff in. You can get some of it in Thinkorswim, the full packages in TradeStation and Trade Navigator. I think a lot of folks that watch me at my live meetings got excited by what I do. And so I cut a deal with John. I don't, as I say in the beginning, no one pays me anything, so I can't take a commission for selling somebody else's product. So I was able to get a little bit of a discount. And the other thing we did is we were able to start a user group. So we have a user group of people that own HGSI and own John Person's TradeStation indicator set. And we meet at least once a month. John comes in frequently to do mini mentoring. And we basically share ideas and help each other become better traders. So if you're interested in this group and you meet the criteria for inclusion, or you want to talk to me about purchasing John's indicators, I can probably still see if I can get you any kind of a discount. No guarantee on that, but I can always ask. Please give me an email, hgsidoc@gmail.com. We share my screens, my scans, and a lot of ideas, as well as my custom symbol list hopefully on a frequent basis. Here's my chart of the week. We just looked at wage. Why did I pick wage? Well, I guess I could say it's in an uptrend since July. It is. Okay. Over the last 5 days, it's up 2.3% in a bad market. Over the last 3 months, it's a little bit above flat. Can't say that about much of the whole market. But clearly, since the market low back here in July, the stock's up, gosh, probably 20, 30%. So wage is in a uptrend, although longer term it is in a downtrend and it still has to get above its 200-day moving average. I respect moving averages. I respect the fact that it didn't make it here. It failed here, it failed here. So I have to be concerned that it's going to fail again. I like the fact that it's coming out of the squeeze. I like the fact that my technicals are green. I like the fact that it had multiple pocket pivots. I like the fact that it has the high closed dojis and the person supporting it, so person indicators. So I am interested in trading wage. You will notice that my buy point at $46.05 is about a dime above the 200-day moving average. So typically, since I'm an end-of-day trader, if the stock closes at or above my buy point, I would put a buy in for the next morning if it takes out either the close or the high of the prior day. If I'm watching it during the week, I might take the trade during the day and go down at tighter time frames. So, because of the high close doji on the weekly, the PPS in place on the daily and weekly, the super strong OBV, multiple pocket pivots, and just emerging from a squeeze on the daily, still in a squeeze on the weekly, I'm interested in wage. I am not going to fight the tape. I am requiring it to move up before I buy it, and I'm also going to look at what the market is doing and take market context. If the market gaps up and is strong and everybody's celebrating the new year, I will probably get filled earlier than later. If the market continues to sell off for a couple more days with some tax loss or tax gain selling, then I won't get filled right away. But here's my buy point, my target, and my stop. Assuming a risk per trade of $2,000, if I'm risking $220 per share or 5%, I can buy 900 shares. Now let me go back into TradeStation and discuss these three lines. What I have found over and over and over again is that my stocks are doing this. I'm just going to put here, rotate. Here's a recent one of our buys. They are running up, they're triggering, they're running up to my buy point, and they're selling off. Now this one actually continued to go up and has not yet been stopped out yet. This is cone. But I can't tell you how many of these picks I've taken. This one has it. How many of these picks I've taken where they have, the lines are off, where they've actually came out of the chute and had a nice day or two, hit my target, and then came back to life. So being that that's what's happening with my positions, I'm going to be smart. I've got my buy point, which gets me above a pivot here and above the 200-day moving average. I have my target at 48.50, and I have my stop right here at 43.85, which represents the most recent last conditional change. If the stock never trades above this white line, I don't get filled. Simple as that. If it trades above the white line, I will take a position, and when I get to the green line, which is my first target, I'm going to expect it to fail. So I'm going to have a signal, a sell stop at or about that green line to dump half of my position. If I can take profits in half my position and at the same point take my stop, which is down here, and move it up to break even, I can't lose money on that trade. That's how I trade this market. Take profits early, leave half on to play, move my stop to break even, and when I get stopped out, I'm out. I can go back in, just like I can buy any other stock, but that's how I'm playing this market. This is not a be a hero, hold on forever. Now, I have lots of options, okay? And let me just fill this system in here. These are a number of bullish trades that I could take. And the numbers are just for demonstration points because they'll all change when the market opens. Some of the spreads will get smaller between the bid and the ask. These are a number of bullish trades. I can buy the stock. If I buy the stock, it's simple. I buy it here, stock goes up, I make money, stock goes down, I lose money. It cost me $4,537 to control 100 shares at the current price. And every penny up is a win, every penny down is a loss. That's if I buy the stock. I could buy just a call. So the call means if I buy one call, I'm going to control 100 shares. So it's going to cost me about $1.50 to buy a $45 call. For me to break even, I'm going to have to get, the stock price is going to have to get to $46.50. At $46.50, I've now have the price of the call plus the price of the option, $1.50, and everything above $46.50, I make money. The beautiful thing about buying a call, there's a couple of things. The most I could lose here is $150, which is how much I paid to control 100 shares. And so for the next 2 or 3 weeks, I control 100 shares of WageWorks. The most I can lose is $150, and my potential gain is infinity. So in fact, one could argue that buying a call gives you almost all the benefits of buying the stock, but it's a lot cheaper because you're only paying the premium, you're only renting it, you're not owning it. One of my favorite trades is doing what's called a synthetic. And in a synthetic, I buy and sell a call and sell a put at the same strike price. Now, I shouldn't be showing you this because you might tell me this is dangerous. And I agree with you. It's dangerous. But notice it's got the exact same, minus the fact that I had to pay $750 to control 100 shares. The exact same P&L of buying the stock did. So I can do a synthetic where to control 100 shares of Wage, I had to pay $750. Now, here's something else that's important. If I bought the stock, I had to put out $4,537. My maximum risk is $4,537. My profits are infinity. On my synthetic position, my maximum risk is $4,507. My maximum profits are infinity, and I'm only putting out $7.50 to control 100 shares. The risk is the same. The cost to play is a whole lot cheaper. If I go back to that buy the call, my maximum profits are also infinity. My maximum risk is the price of the call. So I don't have the downside. The problem with this versus buying the stock is on that third Friday of January, if I'm not above 45, it goes to 0. These are a number of different spreads that I can do. It gives me an idea of how much I've got to pay out of my pocket or get paid. What's my maximum profits and what's my maximum risk. And you notice that some of my most maximum risk is long the stock. So, is there a trade here that gives me infinity gain, limits my maximum risk to below the price of the stock, and pays me to take the trade? The answer is yes. And here's become my new favorite trade. This is called a call ratio back spread. So in this trade, I would be selling short an at-the-money call and using that money from that short to buy 3 calls that are at $50. Now, for me to make money on this trade, this has to go from 45 to 50 and get above $50. My break-even's not to 52. So I have to be very bullish, and I probably would want to look at, say, March or April. So let's look at May. Let's look at this one here. Call ratio, back spread, 2-to-1 May. Okay. So, all right, I'll spend more money. So I'm going to look at this one here. So I'm going to short 1 at the money for May, and I'm going to buy 3 out of the monies. Now, when I sell a call, I have a risk that the stock goes up, and if the stock goes to 80 and I sold a call for $45, I have to deliver them $80 stock, and I just got paid $45. That's how I lose money on selling a call. But I'm protecting myself because I've got 3 more calls that I'm buying to go against it. So here's a trade, and because I added time. Now, if I took this trade for January, which would be a very low probability trade, I get paid $15 to go long 3 calls and short 1 call. I'm going to take the May. Let's take a look at it. Kind of why I like this trade. I now control 200 net long shares or 2 long calls. So I need the stock to get to this point here, $54 or so, for me to break even on this trade. Now, that's 20% move from here. That's probably not going to happen. And maybe it will, but I've got until May. I've got 5 months for that to happen. My debit to control 3 long calls and 1 short call, it's going to cost me $300. That's it. Look at what happens if the stock moves above $54. I can make a ton of money. I'm now controlling 200 shares out here because one of them takes care of the short position. What happens if the stock drops from this point? All I can lose is my debit of $297.50. So, on the long call, or the long stock, I put out $4,500, which is my risk. I had infinity gain, and look at that slope. Here I've got a much higher slope on my gain. My risk is controlled at $297.50. I just have to have the stock move in my favor. So the probability of this being in the money is only 32%. So that's the downside of this trade. I kind of like call ratio back spreads. Not sure that's what I'm going to do here. So I'm going to look at a lot of these different options. I kind of like things that have a chance of working, where I have a chance of making some good money on. So I haven't decided which one I'm going to do on this. My guess is I'll probably do a call ratio back spread. I'm not sure what month and what strike prices. We can talk about that next week. I might consider just buying a long call, and probably not a January call, but let's look at a long call out, say, May. So this is rather expensive. It's going to cost me $500 to control a May $45 call. Stock's going to have to get above 50 for me to break even, but all my maximum risk is the $490 I have to put out to control 100 shares. So a lot of different things that you can do to take the trade. A lot depends upon your risk appetite. I really like that last program because it gives me a chance to graph it and scan it and come up with the best trades. Bottom line is I'm going to be looking to take a trade in wage if the market behaves, if the stock behaves. It's not without risk, but the way that I do it, I think I control my risk by defining clearly targets, entries, and stops, and money management. Again, lots of ways of skinning the cat. And on that note, I'd like to say goodbye. Hopefully I'll be having some live meetings next year. I haven't made a decision yet. My wife wants me out of the house in March, so I will be going to the PV meeting. God willing, they'll have it. Hopefully see you there. Hope you have a great week. I know I was long-winded today, but I figured I had extra time because we're all on holiday. Have a great week. Have a healthy, safe, and happy New Year. And may your worst trades of 2015 be your best. Or your best trades of 2015 be your worst of 2016. Thanks. Bye. Hey, Raj, hold on one sec. Hello, hold on one sec. I just got to stop something.